Meta is crashing roughly 9% after releasing its quarterly results. Buy opportunity. Because looking at the numbers, the picture doesn't seem bad at all. $60 billion in revenue, up 28%, but the market looked somewhere else. And in this video, I'll explain where and why I think that drop opens up an opportunity. In this video, I'll take you inside Meta's Q2 2026 earnings call, the real highlights, the hidden optionality in the business, and why CapEx is the key to everything happening right now. Before we start, a disclosure: at the time of recording this video, I hold Meta shares. Keep that in mind as you watch. This isn't investment advice, just my personal analysis. All the data, financials, and key performance indicators you'll see in this video come from justDCF, a platform that helps with fundamental analysis and speeds up the stock valuation process a lot. Link in the description if you want to check it out too. Let's start with the facts. Total revenue for the quarter came in at $60 billion, up 28%. Advertising revenue within family of apps was $59 billion, up 27%. Ad impressions served grew 14%, with healthy growth across all regions, while the average price per ad rose 12%, driven by performance gains, more favorable macro conditions compared to Q2 last year, and currency tailwinds, though that was partially offset by strong impression growth, especially from lower monetizing surfaces and regions. On the engagement side, Meta's daily active people reached 3.6 billion, meaning that many people now use at least one of Meta's apps every single day. Instagram alone counts 2 billion daily actives, and Facebook is above 2 billion as well. Moving to profitability, operating income was 18 billion, down 8% year over year with a 31% operating margin. CapEx came in at $31 billion for the quarter, and free cash flow was just around 800 million. The reason operating income and cash flow dropped isn't that the business is slowing down, quite the opposite. It's that expenses jumped 55%, including $2.4 billion in legal charges and $1.2 billion in severance, tied to the roughly 8,000 person headcount reduction announced in May. Strip out those one-off items and operating income would have grown 9%, not declined 8%. So the underlying picture is much less dramatic than the gap headlines suggest. So Meta is showing that its AI investment is turning into concrete results on three fronts of the core business. Number one, engagement. On Instagram, time spent grew double digits, driven by improvements to feed and Reels ranking. On Facebook, video grew 9% globally. The reason: Meta has started running every single public Reels and feed post on Instagram through a language model that classifies tone, topic, and quality, that feeds ranking, recommendations, and content moderation all at once. Number two, advertising. The number that stands out here is the 27% growth in ad revenue, described by management as the fastest growth among all major public reported ad businesses. Meta introduced its new generative recommender system this quarter, using large language models to reason about ad content and user preferences together instead of scoring each ad individually, with early pilots driving a 1% increase in app event conversions on Instagram. Separately, improvements to Meta's user understanding models, which analyze ads and organic activity together, combined with its GEM model for ads ranking and sequence learning, generated an 8.3% increase in ad clicks and a 15.7% uplift in conversions on Facebook. Number three, tools for small businesses. 9 million small businesses already use at least one AI-powered ad creative tool, and Advantage Plus, the end-to-end automation suite, has reached a $75 billion annual revenue run rate. On top of that, two smaller but interesting signals: the launch of Meta One, the new cross-app subscription tier, and the fact that over 1 million businesses are already using business agents on WhatsApp and Messenger to handle sales and customer support, including cases like Movida in Brazil reporting a 44% increase in bookings handled via WhatsApp. So the optionality where this story can go is where the earnings call gets genuinely interesting because Zuckerberg laid out three opportunity lines that generate little to no revenue today but represent the real optionality in the stock. Number one is personal agents, not yet launched but described as a massive and almost inevitable opportunity. An assistant working 24/7 on a person's health, finances, and relationships. Zuckerberg was candid. He admitted there is still a gap between today's proto agents, the kind that require tinkering in a terminal, and a consumer product that just works for billions of people. But it's clearly the number one bet for the coming years. Number two, the enterprise opportunity. Here, Meta wants to sell not just advertising but APIs, enterprise scale businesses agents, and the more controversial point, potentially compute itself. Management said clearly they are getting a meaningful number of offers at a significant premium to resell their own compute capacity. But they were equally clear that they would rather not do this at scale because selling intelligence, their own models and products, carries much higher margins than reselling raw compute. Number three, models and the API. Muse Spark 1.1 Meta's agentic coding model is now available through a public API and on OpenRouter for US developers. With Muse Image and Muse Video ramping up, it's an attempt to enter the models as a service market currently dominated by OpenAI, Anthropic, and Google. Then there are the Meta glasses developed with Elisor Luxottica. With early sales, the company described it as exceeding expectations. Reality Labs brought in $431 million in revenue for the quarter, up 16%, driven by AI glasses while cast headset sales slowed. It's not a huge business in absolute terms yet, but it's the hardware entry point for Meta's whole AI on your body strategy. And now the point that in my view every investors need to watch more closely than any other numbers in this call, CapEx. Meta raised its 2026 capital expenditure guidance to a range of $130 billion to $135 billion, up from the previous 125 to 135. So the midpoint of the range moved meaningfully higher. At the same time, total 2026 operating expense guidance also went up to 165 to 169 billion dollars to reflect this quarter's legal charges. Why is this happening? CFO Susan Lee gave a pretty clear and I would say fairly honest explanation. Meta admits its supply constraint, meaning it doesn't have enough compute capacity for all the opportunities it wants to pursue, not just generative AI, but also the core advertising and the recommendation business, where they say they still have numerous ROI positive uses for compute they don't have enough of. The stated strategy is maximize capacity in 2026 and 2027 while staying flexible for 2028 and beyond, building land and power infrastructure now without yet committing to the longer term chip purchases, which are the riskiest and most expensive part. A key piece of this strategy is the joint venture with BlackRock for a 1 gigawatt data center in El Paso, Texas. Announced the day before the call, this is an important signal. Meta is increasingly relying on third-party capital and structured partnerships, not just its own balance sheet to fund the build-out, mixing debt, equity, and now institutional investment vehicles too. Not surprisingly, when analysts asked for 2027 CapEx estimates, the CFO declined to give a number, saying infrastructure planning remains highly dynamic, something worth watching closely in the coming quarters. And this is actually why, in my view, the stock dropped roughly 9% after the release. The market looked past the revenue growth and focused on higher than expected CapEx, a free cash flow that's nearly wiped out, and a 2026 tax rate guidance revised upward to 15 to 17%. In effect, the market is pricing in that today's profits are being almost entirely reinvested with a payoff that will only show up years from now, and not every investor is willing to wait that long. So in my opinion, very strong quarter for Meta. with revenue growing 27% year over year. For a company of this size, that's a huge growth. The market doesn't like the CapEx spending, but I think it's necessary and it's the best way to invest that money. Every dollar spent to build compute capacity could translate into better AI recommendations, better AI products, and a better proprietary large language model to plug into the ecosystem. So overall, better earnings down the line. The thesis is on track. We are getting close to a level where I'll be adding to my position. If you don't want to miss my reasoning and my trades, I share everything in my Discord club. Link in the description. See you in the next video. Bye.